Hey everyone, welcome back to the Financial Freedom Hub. Today, we're diving into one of the most misunderstood aspects of investing, stocks. You might think buying stocks is all about reading charts and making quick decisions based on market news. But let us tell you, there's a much better way to invest, and it starts with understanding the business behind the stock. Let's break this down. Here's the thing. Stocks are just a derivative of the business they represent. What does that mean? It means the stock price doesn't just reflect the health of the business. It's influenced by emotions, tax laws, market sentiment, and even manipulations by big players. You're competing with institutional investors with almost unlimited resources, and nowadays, robots trading in milliseconds. Imagine you're at a poker table, but everyone else is a professional, and you're just learning the game. That's what it feels like to trade stocks based on the market's emotions and external factors. Now, here's the good news. When we learn how to analyze businesses, really understand what makes them tick, we're learning something as basic as the alphabet, and once we get it, it stays with us for life. Take Warren Buffett, for example, one of the most successful investors in the world. He doesn't buy stocks based on short-term trends or news. He buys businesses he understands. His secret? He looks at the fundamentals of the business, not the stock price. Successful investors like Buffett and Charlie Munger are in it for the long haul. They understand that the business is what creates value, not the stock price. And that's where most investors go wrong. Let's look at a real-world example. Remember, when Apple's stock price dropped significantly in early 2016, the decline came after Apple reported lower than expected results for the first quarter of that year. The media frenzy around this caused a wave of panic selling. But when you looked at the business fundamentals, they were still strong. Apple was still generating impressive revenue from its services and other products, and its balance sheet was rock solid. And here's the kicker. During that same period, Warren Buffett, who understood Apple's business model inside and out, made his move. He bought 39.2 million shares of Apple in the first quarter of 2016, despite the stock price dip. Why? Because he knew the fundamentals of the business were still in great shape. Fast forward to 2020, and Buffett's faith in the company paid off. In his annual letter to shareholders, he wrote, "Since then, we have both enjoyed regular dividends, averaging about $775 million annually, and have also, in 2020, pocketed an additional $11 billion by selling a small portion of our position." See how the stock price can swing wildly due to emotions, rumors, or even outside factors that have nothing to do with the actual business performance. If we understand the business, we'll see the true picture and avoid the emotional roller coaster of the stock market. At the end of the day, understanding businesses is the key to becoming confident investors. Forget the noise. Learn how to read financial statements, and we'll have the tools to evaluate businesses with clarity and certainty. If you enjoyed this video, make sure to hit that subscribe button and turn on notifications. And don't forget to check out our other videos where we teach you how to read financial statements and build a solid understanding of any business. Let's grow together and get one step closer to financial freedom.